One of, if not the most popular financial ratio thrown around is the PE or price to earnings ratio, and is commonly used as a gauge for whether stocks are over or undervalued. Is this a rational way of valuing companies, and has it yielded better than average results? I'm not big on numbers or metrics, so I thought it would be interesting to do some digging on the famous PE ratio. A ratio that, even when ignored by some, has an impact on share prices whether we like it or not. So, value or growth investor, US or international, pay close attention. I'm so glad you're joining me for another video. Whether you're a subscriber, regular viewer, or a first-time looker on and you find this video helpful, please consider supporting my work by subscribing and spreading the word. You might find my content different from your average financial YouTuber, and I'd like to keep it that way. So let's tune out the noise of short-term price predictions and the hot stocks of the week and actually learn about investing. A company's price to earnings ratio is determined by dividing the company's share price by its earnings per share, or EPS. In other words, how much does a company earn relative to its market value? Microsoft's PE ratio is currently sitting at about $37. To get to this number, you take the company's share price of $214 and divide it by its earnings per share, or EPS, of $5.76. This determines how much earnings each share you own represents. The higher the PE ratio, the less earnings each share represents. A high PE ratio generally means investors are optimistic about the company's earnings outlook and anticipates that it will grow, and they are thus willing to pay a premium for the shares now for potential growth in the future. The reverse is the case for a low PE ratio. It's also generally accepted that companies of which shares have a high PE ratio poses more potential downside to investors than those with a low PE, since there is more optimism baked into the price. Tesla's PE ratio is currently sitting at 1,124, while Microsoft is sitting at 34.75. Although this implies a lot more optimism for Tesla, it's also a result of the company's difference in earnings. Microsoft earns $147 billion annually, while Tesla makes only $28 billion. And growth for Microsoft is about 14%, while Tesla grew revenues from 80% from 2017 to 2018. Thus, Tesla isn't necessarily 33 times more expensive than Microsoft, but poses more potential upside due to its relatively smaller size and high revenue growth. A study by Campbell and Schiller found that stocks with a high PE ratio usually underperforms the S&P 500, and concluded that up until the year 2000, there were no systemic relationship between the PE ratio and the subsequent growth in long-term earnings, adding that the PE ratio was negatively correlated with subsequent stock price growth, as you can see from this chart, meaning a high PE ratio resulted in worse than average stock performance. Because of such studies and the value school of investing, many investors shy away from high-flying growth stocks and swear to more low PE, value-orientated stocks, paying stable dividend instead. Now, I've personally never felt the need to categorize investments, and I find this kind of approach a bit irrational, as each investment should be considered individually and not discarded simply due to its PE. Since this study was conducted, many investors have claimed that we have entered a new era after the dot-com bubble burst in 2000, and that a paradigm shift in the valuation of stocks have taken place. This has, from what I gather and have personally seen, been supported by staggering results of high PE growth companies, mostly tech, and the long-term shift from value to growth we've seen since 2000. And success stories like Amazon, Netflix, Apple, Tesla, Nvidia, AMD, Domino's Pizza, or Salesforce have all been trading at relatively high PE ratios all the way through, growing fast enough to justify the optimistic prices. These names outpacing of more traditional low PE names like Boeing, General Electric, Johnson & Johnson, Coca-Cola, Ford, IBM, JP Morgan, Procter & Gamble, or Lockheed Martin has only gained speed from about 2010 and onwards. The two big indexes most clearly showing this divide is the Dow Jones and the Nasdaq, the latter more than doubling the gains of its rival. This move has been led by big tech companies, but the Nasdaq also holds growth names in various other industries. However, it's worth mentioning that although the names I listed of the latter have yielded mediocre appreciation, they have paid a stable dividend and held steady through ups and downs. Coupled with potential rotation from growth to value in the future, I think they can turn out to be alright investments. Additionally, there are probably many horror stories amongst the rubble of high PE stocks. But given that most big winners over the last 20 odd years have all had high PE ratios, all but destroys the simple value approach of staying clear of stocks simply because of their high PE. In the case of fast growing companies, a forward PE ratio is sometimes preferred to the current ratio. A forward PE ratio takes into consideration future growth of earnings and compares it to the current stock price. Ideally, growth companies will have a significantly lower PE in the future than their current ones, meaning investors think the company can grow into its rich valuation. So Tesla's current PE, as we mentioned, is sitting at 1,124, but it's slashed to 145 when estimated revenues for 2021 are applied. Now, I'd be careful about forward-looking ratios, as companies or analysts can vastly under or overestimate growth, be it unwillingly or not. And in a way, I personally think some forward-looking estimates are even more useless than the current valuation metrics. The PE ratio is also used more broadly as a gauge of the overall market's valuation. But the S&P 500's average PE compared to its historical average is just about the only one I see used. And if we go back to the study by Schiller and Campbell, they find a correlation with the S&P 500's relative PE and the subsequent moves in prices. So a high PE is usually followed by downturns and vice versa for low PE periods. We have been in a period of relatively high PE ratios, as you can see from this chart, for some while. Also seeing a prolonged bull market trend. But what comes up must come down, and I don't think we should fool ourselves into thinking that this trend will last forever. History tends to repeat itself, and all in all, I don't think it really matters, since I, as an investor, can't possibly control or affect these swings and should therefore not try to predict them. I simply think of a great company as a great investment, regardless of share price or metrics. No one knows what will happen tomorrow, and looking at numbers can only tell you about the current state of affairs, not predict tomorrow's. And although the PE and forward PE ratios tries to put a price on investors' outlook on the future, I still find it obsolete, as investors are just as clueless about tomorrow as my cat. In fact, most of my holdings carry a high PE ratio, but I simply don't care. High PE means investors are optimistic, and I don't consider that a bad thing. It might scare away my mom and dad, but I'm a young investor with a long life ahead of me, and I can afford to take risks. Historically, low PE value stocks might have outperformed the averages, but things have changed in the last decades. These rotations and rocking of investors' appetites will always occur, so your best bet is probably to stick with the companies you believe in regardless of PE ratio. And as a final note, if investing was as easy as looking at some numbers and doing simple multiplication or division, the average investor would do way better than 2% a year, and your financial professor should easily be able to demolish the S&P 500. This, of course, is not the case, and I believe investing is an art, not a science. So that was my little digging on the PE ratio. I hope you enjoyed this video, If you have any questions, drop them in the comments section below. Hope I'll see you in my next one and that you'll learn something about investing today. Until next time.